Trade happily till 11:30 p.m. Yes, you heard that right. While the Indian equity markets are open from 9:15 a.m. to 3:30 p.m., there is another segment that a lot of traders don't know about, which is commodity trading. And here, trading happens from 9 a.m. to 5 p.m. in the first session and 5 p.m. to 11:30 p.m. in the night for the second session. And the second session is especially good for people who are office goers and don't have the time to trade in the normal equity markets. So yes, that is what we are going to talk about today. And as always, trading in either the equity market or even the commodity market, it is a risky game if you don't know what you're doing. So make sure you learn everything right. And in this video, we'll be discussing about what is commodity trading, how do you get started with it, why is there a high leverage in commodity trading, is it legal or illegal to do so, what are the exchanges, which brokers can you start with, what is a minimum capital requirement, and what are the pros and cons you need to understand before you get started with this. So if that's the case, what are you waiting for? This is Ajay Ajith. Welcome to Market Feed. Let's start the video by understanding what is commodity trading. So in a normal equity market, let's talk about that first. We buy and sell shares of large companies. Let's take Reliance, Tata, HDFC. We buy and sell these stocks and it is called as equity trading. Similarly, in commodity trading, if you buy and sell or you trade in commodities, let's say, for example, agro-based commodities like spices, cotton, or even wheat, if you trade in any of these, or if you even trade in non-agro-based, which are, let's say, gold, silver, crude oil, any of these commodities, if you're trading in that, it's called as commodity trading. It's basically what it is. On one side, we said trading in equities, it's called as equity trading. And on the other side, trading in any commodities, it is largely known as commodity trading. So now that you understood what is commodity trading, the next natural question should be, why does it exist? Because in the equity market, it is hopefully very clear to all of you. The equity market exists so that companies can raise funds from the public. Okay, that is why the equity market exists, and you as a public, you can buy and sell shares through the equity market. Similarly, when you think about commodity market, why does it exist? There are no companies here which want to raise money. There are only agri-based or non-agri-based, let's say crude oil, gold, silver, all of these commodities which are having regular trades. So why does it even exist is the best question here. And then the answer is commodity trading is primarily used for hedging purposes, especially by businesses. Let me give you an example. Let's say there is a person called as Charlie who's running a gold shop. So in this gold shop, he's having 10 kg of gold with him. Okay, he has bought gold as stock and he's holding that. Now let's imagine a case where, or let's see how he makes profit there, right? He does not make money primarily from the price fluctuations of gold. He makes money through the making charges of the jewelry that he sells. Okay, so in the gold shop, he is currently having 10 kg of gold and he is not worried about the price fluctuations of gold. He does not care about that. He does not want that. He only wants to make money from the making charges there. In the first day of November, let's say the gold price was 80,000 rupees per 10 grams of gold. And Charlie was what? He was making and selling gold jewelry and he was making a profit from the making charges. But on the day 15th of November, let's say due to some reasons, it could be geopolitical reasons, it could be any demand and supply reasons, or it could be any internal Indian reasons as well. Due to some reason or the other, the gold price fell from 80,000 rupees for 10 grams to 60,000 rupees. So what happens here? Charlie is sitting on huge losses. He has gold which was worth 80,000 rupees. Now it is worth only 60,000 rupees due to some reason or the other. And he's sitting on huge losses. Even if he makes a lot of profits from the making charges, it will definitely not cover the losses that he has incurred with the gold price going down. Let's take a happy scenario next. On the other side, the same guy sitting on the same 10 kg of gold, but the gold price shoots up to 1 lakh rupees per 10 gram. Again, you think he would be really happy because he can sell this gold at a higher price. But what happens in this case? After this 10 kg gets entirely sold out, the next time he goes to buy, right? The next time he goes to replenish his stock, he'll have to pay a much higher price. So again, Charlie here does not like the price of gold moving rather down very quickly, or even moving back up very quickly. He is not caring about the price volatility of the commodity that he is holding. He is only caring about his sales. He is a sales guy. He wants to make more sales by selling his gold jewelry. That's all he cares about. So to get away from all these rapid price fluctuations, commodity trading or commodity futures and options were introduced so that these gold sellers, they can hedge the holdings that they're having today. So today, let's say he's holding 10 kg worth of physical gold in his shop. He can take a futures sell trade. Okay, in the derivatives commodity market, he can take a future sell trade on gold for the equivalent weight or the equivalent amount, and he can hedge his trades. So because in this scenario, if the price of gold falls down, he'll make profits in his future sell trade. And if the price of gold increases, he'll make a loss in his futures sell trade. So you understand what's happening? No matter what, his profits and losses will be balanced. It will be hedged. So that's why commodity markets exist, and that's how business owners use the commodity market. But on the other side, retailers like you and me, we can take advantage of these price fluctuations in gold, silver, natural gas, and all of the commodities, and we can trade in them. Okay, so retailers mostly use it for trading, and institutions or even business owners, they use commodity markets mostly for hedging purposes. So just like how we have NSE and BSE as major exchanges in the Indian equity market, we also have two exchanges here in the commodities market. The first one is NCDEX. Okay, which primarily deals with agro-based commodities. So if you want to trade in wheat, cotton, any of the spices, all of it comes under NCDEX. And on the other side, you have the second exchange called as MCX, multi-commodity exchange, where all the non-agro-based trades happen. And this is where trades happen in silver, gold, zinc, crude oil, or any of the non-agro-based commodities. And yes, these are the only two properly registered and liquid exchanges in India. And just like how we talked about in the Forex video, if you're seeing any other exchanges, it might not be legal. You'll have to look very, very closely into them before you start trading. Now, one more thing to note here, there are a lot of platforms and exchanges which are promoting gold trading. Okay, gold trading, silver trading, crude oil trading, but these are all not falling under INR restrictions. Okay, so whenever you're trading in any of the commodities inside India, you're always trading with INR, you're never trading with USD. So make sure you have that one check also done if you're going after or going into any other commodity based trading apps. So now that you understood what is commodity trading, why it was introduced, where or which exchanges you can start trading in commodities from, you also need to understand it is a derivative only trading instrument. That means like when you're buying equity shares, you can buy and sell shares of a company. But in the commodity market, you can only buy and sell or trade in derivatives of all the commodities that you've known and heard about. So when I say derivatives, trading happens in the futures and option segment inside commodities. Okay, that's all where trading happens. So in the future segment, yes, you can roll over your futures and you can take long-term contracts if you want to hold it like a stock, but eventually it will be having an expiry date. Why? Because futures as well as options are contracts. There is a buyer on one side and there is a seller on one side. That means for every futures buy position that you take, there is an active contract running with a set expiry date with a seller on the other side. So in this world where both of you are in a trade, you cannot hold this trade indefinitely. There is a settlement date and that is called as a expiry date for you. So make sure you learn everything about futures and options before you get into the commodity segment. I've heard a lot of people saying or discussing that commodity trading is for beginners. It can be started by anyone. But for anyone who doesn't understand this F&O segment, I would request you please do not get into this or jump into this without learning. And one major point that I want to remind all of you is that in the commodities market, yes, trades happen in the futures and options segment, and a result of which there is a settlement process which happens. Okay, so I would say as a retailer, never try to let your trades enter into a settlement phase. Always try to square off at least 2 to 3 days before the settlement or the expiry date. Okay, your broker will be intimating you, they'll be sending you mails and they'll be sending you reminders on how many days before you have to square off. So make sure you follow that properly, or if you're very close to the expiry date or the settlement date, try to trade in the next contract. So let's say now it's the 25th of November and the next contract expiry is on 27th. try to trade in the next month's contract. So that will also help you escape from this settlement problem that commodities have. Guys, trust me, you do not want to get into physical settlement at all. So once you understand all of that and you decide to jump into commodity trading, the next question should be, where should you go? Okay, now that you understood this agri or agro-based and non-agro-based commodities, and even inside both of them, there are a lot of different contracts. Where should you be heading? So I'll give you 4 major contracts which are highly liquid in the commodity market. So they are gold, silver, crude oil, as well as natural gas. Yes, these are mostly non-agro based commodities, but that is just the way it is. It could be either because of the convenient market timings of these commodities and the matching of this non-agro market with the global market. See, if it is open till 11:30 p.m., you can take trades based on the international movement of gold also. Okay, that could be a reason. A lot of companies actively transact in that for hedging purposes using the MCX. So it is highly liquid. And the fourth thing could be because there is high spikes in all of these 4 instruments that I talked about. Okay, these are generally 4 very volatile assets. Because of that reason, a lot of retailers are also interested in trading in these 4 categories. So now that you understood what is commodity trading, why does it exist, how you can get started by learning about futures and options, and fourth, you also learned about the exchanges as well as the most active, most traded contracts. The next thing would be for you to understand that there are subcontracts under each of them. So MCX provides 4 subcategories just for gold. Okay, so the first category of gold is called as gold itself, and it's having a contract size of 1 kg. So what will be the value of that contract? It is worth 1 kg of gold. Okay, so in today's numbers, it will be worth nearly 80 lakh rupees for you to trade in this gold major segment. Similarly, there are more categories which have been made with the sole purpose of making gold trading more liquid. Second, they have the gold mini category, which is trading with 100 grams of gold. Then they have the gold guinea, which is trading with 8 grams of gold. Then they also have the gold mini, which is just trading with 1 gram of gold. Similarly, silver also has multiple contracts. The main silver contract is for 30 kgs. The next one, which is called as silver mini, it is trading with a contract size of 5 kg. And the third one, which is silver micro, it is trading with a contract size of 1 kg. So this has been designed in a way that there are a lot of lower tiers available so that liquidity is high. And a lot of people can easily buy and trade in this commodity segment. That is why this mini, this micro, everything has been introduced. And for that exact reason, it is often the smallest contracts that see the highest number of trades happening and the highest liquidity happening. And similarly, there are different contract values for crude oil as well as natural gas. I'll show that in the screens here. So the next question is always going to be, what is the capital required to trade in any of these segments? So one thing that I'll add here, all the major brokers in India already support the commodity segment, which are they? Zerodha, Upstocks, Fires, Angel One, let's take even HDFC. All of them support this commodity segment, but it will have to be activated as a very separate segment. You'll have to go into the profile section. If not activated already, you'll have to go ahead and activate the commodity segment. In fact, you'll have to activate MCX and NCDX separately in all of the brokers that you're trading in. And now that we're in the segment of how much money or how much margin is required to trade in these futures and options, you also have to understand that most brokers have a separate balance for commodities trading. Okay, so whatever normal equity and equity FNO trades that you happen on one side, that happens in a separate account balance for your broker, while the commodity segment, the entire commodity segment trades happens with a separate account balance. Okay, make sure you note that. Now there are few brokers which are changing this, like Zerodha, which now use a common or a unified balance for both equity as well as commodity market trades. So to understand how much margin is required for you to trade any of these instruments, I've opened Zerodha's commodity margin calculator, and here you can clearly see how much money is required for each of those categories. Okay, let's take gold M for example, which is having a lot size of 100 grams. So if you're taking a normal gold mini category for 100 grams of gold, the price of the trade should be somewhere around 7.2 lakh rupees as of today. But here, the price of a trade of a contract is only 72,000 rupees. That means there is an inherent leverage that you're getting whenever you're trading in the commodity segment. And if you click on the calculate button here, you can clearly see for how much ever cash that you have, how many lots of this particular, let's say gold M can you trade. It is very clearly displayed here. So similarly, you can come check out all the margins required for categories like natural gas, silver, and even crude oil. I'll put the link in the description down below. Now there is one more thing, just like how Nifty and Bank Nifty exists, where you have the largest 50 companies in India calculated as a single index upon which you can take trades. Similarly, in the commodity segment, there are three major indices. Just like how Nifty tracks the top 50 stocks, there is a bullion index on one side which tracks the price movement of gold as well as silver. And again, you can only trade in futures and options even in this segment here. And on the next side, we have the metal index. Inside the metal index, you have aluminum, copper, lead, zinc, and nickel, which are again tradable instruments, but it will be packaged in the form of an index and you can trade just in this index here. And the third index is called as energy index, and this is just crude oil as well as natural gas. This combined is called as a energy index inside MCX. Now we get into the last segments of the video, which is pros and cons of commodity trading. So the first pro that you have to understand here is that there is very less chance for price manipulation. Now, because most of these tradable instruments are traded not just on the Indian level, but on an international level, there is very less chance for wrong price discovery to happen or wrong trades to happen. Because if for any reason gold price in India moves down and gold price in the US moves up, it is a perfect hedging opportunity or a perfect arbitrage opportunity. So the algos as well as the big players will always strive to make sure that the Indian markets as well as the global markets, they're moving in a similar sense. So because of the crores or the millions and millions of dollars pumped into the commodity markets across the world, there is very less chances for price manipulation. You have to understand that. Now, the second pro that I've seen and observed is that these commodity markets often tend to follow price action really well. So for all of you price action traders out there, or if you've become a master in price action by trading in equity markets, then commodity markets might be a worthwhile investment of your time for you. Okay, so now that you're done with the equity market by 3:30 p.m., you can get into the commodity market from 5 p.m. to 11:30 p.m. and you can start trading there with just the understanding of margin, the risk involved, as well as the price action rules. It is also good for office goers, serious traders who are good at what they do, but they're not having the time because the equity market closes at 3:30 p.m. They can also come check that out. And obviously, it is amazingly regulated. It's a very safe place to be in if you're trading in either MCX or NCDX using any of the SEBI-registered brokers in India. It is a very regulated space, and I would say it is a much better place to be at than Forex and crypto in India. And the last pro that I would say here is taxation is no different than futures and options taxation in the equity market. So again, money that you make here is considered as business income. It can be set off against business losses or even business expenses, and you'll have to pay tax according to your tax slab. So for traders who are already active in index F&O, you do not need to worry about any additional taxes or complications there. It is straightforward. And now let's get to the cons or disadvantages of commodity trading. Now the first one here, I would say, is a high price volatility. Okay, if you're a really good trader, you can make amazing use of that. But if you're a beginner trader, the high price volatility will knock your shoes off and you'll be ending up with lots of losses. And combine this with the second disadvantage. Yes, the disadvantage here that it is having high leverage. You would be having very big losses. Okay, so if you don't know what you're doing and if you don't know how to use leverage really well, you might end up in a lot of losses. So make sure you take a lot of care before you get into this world of commodity trading. Not everything that shines is gold. Okay, make sure you have that in mind and make sure you enter this segment with a lot of care and after a lot of studies. The third con, I would say, it is volumes and liquidity. Not all contracts have the enough liquidity that you're looking for. Especially if you're coming from NSE and BSE, you will not find similar liquidity in most of the contracts. So again, there are very few contracts. Again, I'll show their list here on the screen, which you should be focusing on, and those that have the highest level of liquidity. So try to stick only with them. And the fourth con is the commodity markets are highly reactive to geopolitical problems. If there is any geopolitical problems going on around the world, the commodity markets will be the very first markets to react, maybe even before or even harsher than the equity markets. So again, you need to not just understand about the commodities that you're trading in, the price action with which you're trading in, you'll also have to keep an eye on geopolitical problems and international factors before you get into the world of commodity trading. So hope that this video has been a good introduction for you into the world of commodity trading. Now you've understood what is commodity trading, why it exists, even including the advantages as well as disadvantages of this. And now if you're interested in this segment more and if you want to figure out more of it, you can ask me in the comments down below and we can make follow-up videos for commodity trading. As always, I want to give you a reminder that whenever you're going to study something new, always keep a very low capital sizing. Do not deploy your entire capital into it. Okay. I give the same advice whenever someone wants to go try option buying as well. Always try to deploy a larger capital. If you're already an option seller, you know what you're doing, you're making money from there, deploy a larger capital in an option selling strategy, either your own strategy or automated through market feeds, automated trading systems. Okay. And the remaining maybe 5 or 10% of your capital, you can use it for discretionary trading to try and figure out option buying, to try and figure out even commodities trading. You should never be trading in a new segment that you don't know and that you're not an expert in. You should never be trading with 100% of your capital. So hope you got a lot of value from this video. Make sure you hit the like button if you like the content. Hit the subscribe button if you want to see more. This is Ajay Ajith signing off. See you all again. Bye bye.